All right, MK says, do you have any tips for selling puts? And what we're talking about there, I don't. Oh, naked puts, yes. Very good. Cash secured naked puts. Do you have any tips for selling puts when you want to own the underlying instrument? I.e., how much time ETC, how much time value ETC, for example, using QQQ? Well, I don't need to use an example. We will, but I don't need to use an example because there's no one answer to that question about the time value MK. What do I mean by that? It means it comes down to what you're looking for. What are your personal goals? What is your target? Okay. If I solely wanted to sell a put option to own QQQ right now, but not at QQQ's current price of 270.45, what you have to ask yourself is what target is right for you? Simple question. Okay. I can't answer that for you, whether I go 14 days or whether I go 28 days out in time. Now, let's say my target is 250. All right, well, I can sell the 250 put 14 days out in time and get $1.84. Well, that's not bad. That's what, a 0.3% return yield on the capital invested, roughly. Let's just sell one. 0.8, I'm sorry, 0.8% return on the yield there. Okay. But now we have to stop. You want to get in at 250. What is the likelihood that in this 14 days we're going to see QQQ drop another 10%? Wow, it's less than that, 7.5%, 6%, down to 250, where you'd be put the position. Well, it's probably very small. And it's a lot of capital to make 0.8%. That's why I chose the shorter position 2 weeks out in time. That's not a bad return on an ETF for 2 weeks out in time. But if you're looking to get into it now, you really, really want to get into this position, well, you probably want to sell shorter term, and you're probably trying to maximize your time value by being right at the money, taking a chance. You don't care if it falls. And if it falls here and you get 750, what's your cost basis? Oh, it's 262.50. That's not too bad. That's not a bad price. But this comes down to you. This is a question that I can't directly answer, of course, because I don't know what your targets are. But again, this is a good yield of 2.9% for 14 days. You've got about a 48% probability that you'll get put the stock and it'll be trading below 270 at September 25th expiration. Your cost basis would drop down to that 262.50. Is that where you want to be? Okay, well, if not, you wanted a more premium, what could you do? Well, now you could go out 28 days to the at the money 270 strike with a 50-50 shot of being put the position. You would increase the time value naturally, but the annualized return would lower. So that's where it's unfortunate here, where it has to say it comes down to your goals. All right, it comes down to your goals of what you want to achieve and what target price you would want for QQQ. If you really want to own the stock, you just want it a little bit less, I'd say go 2 weeks out and focus on at the money. If you're not expecting any kind of major pullback, another 6 or 7% pullback over a 5 to 10 day period that we saw recently, that's what you'd look to do. Your targets and your goals. Yes, if I'm going 14 days out in time, even on an ETF, I want to see a 0.7, 0.8% yield. That 250 gave me that. That was okay. But I have to accept there that I'm probably not being put the stock. That's going to expire worthless and I can sell it again every 2 weeks, getting about 0.5, 0.6, 0.7%. Is those your goals, MK? Probably not. That's why you want to establish the goals for the position first. Yes, you want to get into the position, but at what price? Then analyze the puts to say what price and a reasonable probability of getting assigned and into this position, if that's what I want right now, gives me the cost basis I want. Now, looking at this structure very quickly, before we get to Mark and Frank and then William, and I won't bump William again, but these are the quick questions. Jesus says, when is the best time to sell a covered call, which is a parity trade, to the naked put? You have the same risk reward. If I bought 100 shares of QQQ right now and sold the 270 call for September 25th, I'd be close to a 3%, 3.1, 2.9% return if the stock's trading above the price. If the stock falls, I have the same risk exposure. I'll be put the stock for a lower price. But the real question here is, when is the best time to sell covered calls? How do you select your stock to sell? Okay. A covered call position is a neutral to bullish strategy. I want to feel confident that I'm in a neutral to bullish market and that no expectations are coming up soon. I want to review this very quickly in relation to Jesus's question here. Okay. And I'm sorry about that. What I'm saying here is that we're seeing neutral on the market sentiment. A customer asked me today, well, is now the time to switch to iron condors, iron butterflies, and so forth? That's not really what this tool is saying. This tool is saying that for the past several weeks, we have seen the bearish sell warning, the sell warning, and we took our lumps with that. Well, we didn't take our lumps, but what we expected to happen happened. We saw the pullback we expected to happen when the sell warnings were there for an extended period. Maybe not as much as we thought, but what did that do? That eased off all the valves. What do you mean by valves? The 13 indicators here. Let me close out the graph there. But the 13 indicators here that were pushing neutral to bullish and neutral to bearish. The VIX went back to slightly bullish after that pullback. Okay, the trend went back to a neutral area. The number of days the number of days SPX is over its 100-day moving average is still bearish, but all of the others sort of went back. In fact, the MACD gap went back to a bullish indicator. Okay, so it's sort of like seeing the pressure too high on a boiler, releasing some of the excess buildup and the excess pressure and steam, and then going back to a more stable market. This doesn't mean that the market's going to be neutral for an extended period of time. What this means is that those bearish warning signs have been eased. The pressure for the bearish signals have been released, and we're back to what we'd expect the conditions to be before we were really in that overbought cycle to go back. And the trend was we wanted it to go up after, of course, considering that huge February to March decline. So I'm just going back here for a moment into the history. I want to go back into the history here. I don't think this was a good time. I mean, you're seeing sell warnings here, but this was an okay time to do covered calls. But you wanted to sort of close them here. You wanted to add protection or close those covered calls at that point when it was building, it was overbought before we needed that little easing. And I'm not even going to say we're done or that we've had a full correction yet, but we've had this easing of the pressure of the bearish sell. When is the best time to sell a covered call? When you're in a neutral to bullish market, you feel confident that you're in a neutral to bullish market. And you had mentioned what type of stocks would you select? Well, I'd look for criteria in the power options screen or using those default criteria there. Depending on if I want to approach, remember there's 3 approaches to covered calls. You could be at the money to maximize time value, out of the money, above the stock price if you're speculating, if you're speculating on more growth, very speculative, less downside protection, or in the money where I don't care about the stocks and I'm hoping to be assigned and earn that 1, 2, 3% return over a 20 or 30-day period. And when I get assigned, just move on into the next positions. That's the type of market, neutral to bullish. So what am I going to do as far as the stocks go? In this case, to look for positions. I'm going to look for stocks that are trading in an uptrend above their 20-day or 50-day moving average. I may look for a positive MACD where the MACD signal has been positive over the last 2 to 3 days. I'm going to look for stocks that have a good earnings per share growth reflecting good management over the last year, have a reasonable PE ratio, and I need to avoid stocks that have earnings between now and expiration, same as I would with a credit spread or a debit spread. Those are the things I'm going to look for. The same things I would look for essentially if I was just going to buy the stock without the hedge of a covered call. That's what I'm going to look for in the stock itself. I want a bullish stock that's shown good management, good growth potential, is trading in the uptrend, but at the same time gives me the minimum return, downside protection, and the time frame that I want as well. And that's where we start with the default criteria. Even if I go to at the money to maximize the time value return, some good positions here. These are 35 days out though. But you see here, I'm still looking for stocks in an uptrend, good earnings per share growth, good PE. This is what we put in for the default criteria that Ernie puts in the default criteria when he's looking for his covered call positions. If you're fearful of the market right now, you want to generate income on the positions, okay? You want to go ahead and get income there in that case, but you want protection, then instead of doing a covered call, you're going to look at a little bit what we looked at earlier with our first discussion related to the question from David, take out bear call. Okay, and I would look into the long collar, which is essentially an at or just out of the money covered call with a much lower strike put for protection. So in an uncertain market, you may want to go with the collar instead of just the covered call. I can still get reasonable return if assigned, even with buying the put if the stock is trading above my short call strike price with having the protection in place. Let's go to just standard October. 35 days out. Maybe a little bit too far. I could easily go weeklies here. Yeah, max risk is not going to go higher than 7%. Max return is good. Okay. So let me just change that up a little bit and run our search. There we go. This is almost, it's greater than a 1-to-1 risk reward ratio. Apple's at 112. Sell the out of the money 115 call for 515. Buy the 107.5 put for 445. Okay, so at midpoint, we only get about 75, 80 cents, 85 cents of premium. But if the stock's above 115, I still make 3.5%. And if the stock falls, drops below 107.5, I'm only risking 3.3%. Not as good as a time protection as the Marriott put we looked at earlier following the radioactive trading techniques, but definitely a low risk trade with still the potential to make a reasonable return. If the stock stays right where it is, you still make 0.8%. The percent if unchanged. Maybe not great for a 35-day trade, but it's not a loss. And if Apple tricks us and the market tricks us and it falls 10%, the worst case scenario you can do in a standard collar, of course, is lose that 3.3%. $365 off an investment of $11,115. Not too bad at all. Okay. Covered calls are neutral to bullish. You want to be in a neutral to bullish market and to find the stocks you want to do to be reasonable covered call. You don't want to look for bearish stocks or bouncing stocks or stocks that have been depressed that you feel are going to pull back up for a covered call in a neutral to bullish market. You want to find the positions that are going in the same trend, neutral to bullish, to match your criteria and the sentiment for the structure itself. All right. Okay, real quick. Frank says, how do you adjust the x-axis in the sentiment graph? I don't think we have a way to do that. Let me see here. There we go. Oh, this is okay. So you're talking about here. I'm going from October 2017 on the market sentiment graph to today. And Frank wants to know, how can I change this axis so I'm not doing it? Down below here is the scrubber. Okay, it's what that's the technical term for it. So I can just select it here. Click over to the right there, Frank, drag it over, and now I've got my little slider. See the gray slider moving back and forth? Now I'm only going from February to September. And I'll move it shorter. Now we're just looking at end of August. Now let's go to August. Let's go to beginning of August. There we go. So now we're looking at basically the beginning of August to September. Okay, so that's what you do. Just click and interact with that lower one there, Frank. That'll get you what you want.